Welcome to 2017 and our first quarterly economic update. Due in large part to recent gains, investors need to be watchful of the current valuations of equities. The year 2017 starts with the S&P 500 index trading at 17.1 times next year's earnings estimates. Based on historical results, this is considered ambitious but not ridiculous. Recent corporate earnings have shown slight growth after a year of shrinking earnings. FactSet Research tallied estimates for earnings growth of 12% in 2017, but other analysts are less optimistic. They feel that investors have ridden the bull market for 8 years, and while they don't expect the ride to end in 2017, they are warning investors to stay vigilant. They are predicting that the S&P 500 will increase by only 3% in 2017. In the U.S., we are not on the brink of a recession. We expect the economy to grow by 2 to 2.25% in 2017. Recession risk has fallen since last month to be less than 25% over the next 12 months. Typically, recessions are more likely to be caused by fundamental economic imbalances, including excessive investment and increased credit. None of these conditions exist today. Most of the weakness in recent U.S. data has been centered in the industrial sector, where declines in production have been broad-based. Overall, domestic demand remains strong, and other three indicators, real personal income, real business sales, and non-farm payrolls, used to determine the official turning points in the economic cycle, are still growing at a healthy pace. The underlying strength of the labor market and the steady improvement in the economy have led the Federal Reserve to forecast several interest rate increases for 2017. Interest rates hit a low of 1.36% for a 10-year Treasury in July of 2016 and increased to over 2.4% by year-end. In December of 2016, the Fed's so-called dot plot showed the central bank penciled in 3 rate hikes in 2017 instead of 2 under its prior forecast. Investors need to be watchful in 2017 for market corrections caused by possible blow-ups in China and Europe. The second and third largest economies in the world enter 2017 facing many obstacles. China's main challenge is making the shift from an export economy to a consumption economy. There are numerous obstacles in the way. Right now, the biggest problem is the weak yuan. Chinese investors are scrambling to convert their cash into dollars and move it out of the country, sapping the treasury of funds needed to make the transition to a more mature, consumption-based economy. In Europe, there are a slew of elections due to take place in 2017. Also, there is a potential for bank failures in Italy, Europe's third largest economy, which would cause big problems for Europe and possibly the entire globe. So what should investors do? The year kicks off with a new president, higher interest rates, stocks at all-time highs, and new risks and opportunities. In their 2017 outlook, Goldman Sachs predicts that while we recommend clients remain invested, we have modest return expectations. We expect that a moderate-risk, well-diversified taxable portfolio will have a return of about 3% in 2017. USA Today review of predictions from 15 Wall Street strategists finds that America's fortunes won't add up to big stock market gains in 2017. They report that the group's average year-end 2017 price target for the Standard & Poor's 500 should produce a net gain of 4.5%. One prognosticator sees the S&P 500 gaining more than 10% next year on top of the gain it posted in 2016. Not one of the 15 strategists sees the stock market posting losses next year. The lowest 2017 year-end price target of 2,300 equates to a gain of less than 2%. At MMFS, we continue to hold to our proven disciplined investment management process, which diversifies portfolios across many asset classes. We build investment models using long-term return expectations and reducing volatility measured by standard deviation as much as possible within a given return target. Further, we populate these portfolios with holdings in which we do significant research. Thank you for listening. Feel free to call us if you have any questions.